You think you understand debt. You don't. You think debt is a number on a screen, a monthly payment you either make or miss, a problem that gets solved when the balance hits zero. That's the version they taught you. That version is wrong. Debt is a system. It is an architecture specifically engineered so that the people inside it feel like they're making progress while they're actually funding someone else's wealth. And the thing that makes it genius, the thing that makes it the most effective financial trap ever constructed, is that it feels voluntary. You chose the card. You signed the loan. You clicked accept. Nobody put a gun to your head. They didn't need to. They had something better. They had compound interest, a sales team, a checkout button, and the human brain's complete inability to feel the difference between $400 a month and $14,000 spent. Here is what I want you to understand before we go any further. Debt is not one thing. Debt at $3,000 is a different organism than debt at $30,000. Debt at $30,000 behaves completely differently than debt at $300,000. The strategies that work at each level are not just different, they are sometimes the direct opposite of each other. And the financial media, the budgeting apps, the TikTok finance influencers, they treat debt like it has one universal solution. Cut the lattes, build the emergency fund, Snowball or Avalanche. That is kindergarten finance. We're not doing that here. What we're going to do is go through debt the way it actually lives, level by level, and show you exactly how it is acquired, how it compounds, what it does to your psychology, and how people actually eliminate it. Not the inspirational story version, the mechanical, tactical, uncomfortable truth version. Pay attention. This is going to cost you nothing and save you years. Level 1. You owe between $1,000 and $5,000. This is credit card debt, probably. Maybe it's a medical bill. Maybe it's a personal loan you took when your car needed a transmission and your savings account was a myth. The balance feels manageable. That's the trap. Manageable is the most dangerous word in personal finance. Here is what is actually happening at this level. You have a $3,400 balance on a card charging 24.99% APR. You pay the minimum, let's say $85 a month. You feel responsible. You're paying it. Except at that rate, you will spend 5 years and $1,900 in interest eliminating a debt you created in probably 6 weeks of normal spending. The bank isn't charging you interest on a loan. They're charging you a tax on impatience. And the minimum payment is not designed to help you get out. It is designed to keep you in, producing interest revenue for as long as mathematically possible. The people who actually escape this level don't just pay more, they stop the bleeding first. That means no new purchases on the card while carrying the balance. Not fewer purchases, zero. The card goes in a drawer. Then they apply what I call the 48-hour rule. Any non-essential expense over $50 gets a 48-hour mandatory wait. Not because you can't spend the money, because impulse spending is what built the balance in the first place, and discipline is a muscle you have to train before you need it at the next level. Then they attack the balance with every dollar they can free up, not from sacrifice, but from reallocation. The $14 streaming service you forgot you had, the gym membership that sees you twice a year, the subscriptions that auto-renew like clockwork while you sleep. Level 1 is solved with attention. Most people don't have an income problem at level 1, they have a leakage problem. Level 2. You owe between $5,000 and $25,000. This is where debt stops being uncomfortable and starts being structural. This is student loans sitting alongside a car note, sitting alongside 2 credit cards, sitting alongside a buy now, pay later balance you started in December and haven't thought about since. You have multiple creditors, you have multiple interest rates, you have multiple due dates, and your brain, which was designed for a world where you could see your threats, cannot process these simultaneously. So it does what overwhelmed brains always do. It avoids. Avoidance at this level is catastrophic. Every month of avoidance at 21% interest adds fuel to a fire that is already burning. The specific mechanics that work here involve one concept that most people hear and immediately dismiss: interest rate arbitrage. This is not complicated. It means you stop accepting the interest rate the bank assigned you and you start negotiating or transferring to a rate that works in your favor. A balance transfer to a card with a 0% promotional period, typically 12 to 18 months, is not a gimmick. It is a window, a legally available pause in the bleeding that, if used with surgical precision, can allow you to eliminate principal without hemorrhaging interest simultaneously. The people who use this tool correctly treat the promotional period like a countdown timer, not a relief valve. They don't relax when the rate hits 0%. They accelerate. The other thing that happens at this level that nobody talks about is identity debt. The money you owe is one problem. The person you've had to become to owe it, the avoider, the minimizer, the person who deletes banking apps so they don't have to see the number, that psychology is the second problem, and it outlasts the balance. People who eliminate level 2 debt without addressing the behavioral pattern that created it are 6 to 18 months from recreating the exact same situation. The balance changes, the behavior doesn't. That's not a money problem. That's a self-awareness problem wearing a money costume. Level 3. You owe between $25,000 and $100,000. Student loans at this level are common. So is a combination of a mortgage down payment you put on credit, a car you financed when you should have bought used with cash, and a home equity line you opened with good intentions and spent on the wrong things. At this level, the debt has a gravitational pull. It shapes decisions you don't even realize are being shaped. You don't take the lower-paying job you actually want because you need the salary. You don't leave the city with the high cost of living because the debt requires your current income. You stay in the relationship, the apartment, the career you've outgrown because the debt made the decision for you. This is the level where people start to understand, painfully, the difference between a liability and an investment. A student loan attached to a nursing degree that generates $80,000 a year in income is a financial instrument. The same loan attached to a credential that generates $38,000 a year is a trap with a diploma on top. The debt doesn't know the difference. The interest accrues identically. Your life, however, does not. If you are watching this right now and you recognize yourself in this level, I want you to do one thing before the week is over. Pull every debt you owe into a single document, not an app, a document. Write the creditor, the balance, the interest rate, the minimum payment, and the payoff date at current payments. Then look at the payoff dates. Most people have never done this. Most people who do it for the first time feel physically ill. That is not a bad thing. That nausea is clarity. Clarity is where strategy starts. At this level, the income side of the equation becomes impossible to ignore. You cannot cut your way out of $80,000 in debt on a $55,000 salary. The math will not cooperate no matter how many times you run it. The conversation has to expand to include income acceleration, a second income stream, a skill that commands a premium, a side operation that generates $1,500 to $2,500 a month specifically earmarked for debt destruction. Not for lifestyle, not for savings, not yet, for elimination. This is also where I want to pause, because if what I'm laying out here is hitting differently than the generic finance content you've been consuming, subscribe and turn on notifications, because every week I'm publishing the version of financial education that actually maps to how money works at a system level, not the oversimplified version designed to make you feel good without making you financially free. Level 4. You owe over $100,000. At this level, debt is no longer a personal finance issue. It is a business problem, and it must be treated with the same cold, unemotional analysis a CFO applies to a balance sheet. The people who navigate this level successfully share one cognitive shift. They stop thinking about their debt as a moral failure and start treating it as a position to be unwound strategically. Guilt does not reduce interest. Shame does not accelerate payoff timelines. What works is sequencing.
identifying which debt is costing you the most in real dollars annually and attacking it with disproportionate force while making minimum payments on everything else. Not the smallest balance, the highest cost. At this level, the difference between targeting the highest interest debt first versus the lowest balance is $30,000 in total interest paid over a 5-year period. That is not a rounding error. That is a car. That is 2 years of a child's education. That is real money. What also works at this level is understanding your debt-to-income ratio as a lever, not just a number. Lenders use this ratio to determine what you can access. A strategic refinance, converting high-interest unsecured debt into a lower-rate secured instrument when you have the assets to support it, can reduce the monthly interest burden by enough to meaningfully accelerate principal reduction. This is not financial magic, it is product arbitrage. You are shopping for the cheapest cost of capital the way a business shops for the cheapest cost of goods. There is a version of debt freedom that nobody shows you in the testimonials. It is not the confetti video. It is not the screenshot of the zero balance. It is the morning, 3 or 4 years into the process, when you realize your brain has changed. When you sit across from a car salesman and he says the monthly payment is only $480, and instead of nodding, you automatically calculate the total cost, the interest rate, the opportunity cost of that capital deployed differently, the insurance increase, the depreciation curve. You see the whole system, not the monthly number. That is the real product of paying off debt at every level, not the zero balance, the new cognition. Because the financial system does not change. It will always have a new product engineered to extract wealth from people who see prices instead of systems. The interest rates will change, the product names will change, the marketing will get more sophisticated. What will never change is the underlying mechanic. Transfer wealth from people who react to people who plan. Debt is not your enemy. Ignorance of how debt actually functions is. And the distance between those two things is exactly what you just covered. Start with the document, write it all down, look at the payoff dates, then begin.